Bene. Ni Imana ibizi yonyine. Wenda abo ngabo bafite amafaranga. Ahari hose hari amafaranga umuntu arahagije. Wongeye muri class. Uri kwiga online. Nta kibazo.
So welcome to today's class. We want to move on from where we had stopped. Last time we were on budgeting. So we are going to chapter 14. Chapter 14 may take us around 2 classes. So that means today and maybe on, maybe if I may ask, on Saturday at 1. Do we have a class Saturday at 1? Anybody with a class Saturday at 1 this Saturday, this coming Saturday? Anybody with Saturday at 1? Saturday at 1? If you have a class, how many are doing information systems? I saw information systems in the timetable. Anybody here who is doing information systems? Information systems? So can I request, because there is a class that I'm teaching the same topic, I'm introducing it tomorrow in another class, and then Saturday will be at the same level. Can we meet on Saturday at 1? If it is okay, we can meet Saturday at 1 so that we cover something. Saturday at 1. Let's meet Saturday at 1. I hope you are fine with that. So remember that Saturday at 1 for a makeup class, but I'll combine you with another class. So I'll be combining your class with another class Saturday at 1, so that at least we try to make up for the other topics that which are remaining. Remember, we have not covered chapter, is it chapter 10, 11, and 12? Chapter 11 is the shortest. So chapter 11 is very short. Can take us like 30 minutes. So those 3 topics, I wanted us to finish them this month. So if we meet Saturday, we'll be on track. So remember that. So let's start so that on Saturday when we meet, we are at the same level with the class we are going to have we are going to have another class with some group, not this group, another group tomorrow, not this group. Okay, so let's look at the chapter standard costing. And whenever we are talking of standard costing, it's good to start by defining what is a standard cost. A standard cost. Standard cost. So standard cost is the definition is a planned unit cost, planned cost per unit, cost per unit of a product or a service. So when we talk of a standard cost, it's a planned unit cost of a product or a service. A planned unit cost of a product or a service. So if somebody asks you what is a standard cost, it's a planned unit cost of a product or a service. Planned unit cost. When you plan that this will be the cost of maybe a chair, this will be the cost of one table, this will be the cost of one box of markers. In that case, we call it a standard costs. We also have what we call types of standards. Types of standards. Types of standards. What are the different types of standards that we have? Types of standards. There are 4 types of standards: planned unit cost of a product. We have what we call number 1, ideal standard. Ideal standard. So the first, and this is a common question in exams, ideal standard. So the first type of standard is what? When we plan to cost a product, the first type of standard that we use to plan is called ideal standard. So what is an ideal standard? It's a standard that is based on perfect operating conditions. A standard that is based on perfect operating conditions. So when you set a standard and it assumes everything is perfect, in other words, no wastage. The company does not waste anything. No idle time. The employees are not idle at any given time. No spillage. Maybe if we are processing some oil, there is no oil that spills, etc. That is a standard that is based on perfect. Everything is perfect. So ideal standard is a standard that is based on perfect operating conditions. The opposite of ideal is called attainable standard. Attainable standard. Attainable standard. So ideal is a standard that is based on perfect operating conditions. So what is an attainable standard? When we talk of an attainable standard, this is a standard that is based on efficient but not perfect operating conditions. It is a standard that is based on efficient but not perfect. It is based on efficiency but not perfect operating conditions. Yes, attainable is the same as achievable. Achievable is the same as achievable, but the word we use is attainable. So it's a standard that is based on efficient but not perfect operating condition. Is a standard that provides for wastage. They recognize that there can be some small wastage. It provides for idle time. It provides for spillage, that there can be some oil that spills in the process, etc. That is called an attainable standard. That is called an attainable standard. A standard that is based on perfect, on efficient, on what? Efficient, but not perfect. Not perfect. Not perfect. This one is based on what? Perfect operating, based on perfect operating conditions. Number 3, there is what is called basic standard. Basic standard. Basic standard. This is a long-term standard that remains unchanged over a period of time. It is a standard that is always same. It does not change. A long-term standard. So when we set a standard maybe for the next 5 years, that is called a basic standard. So what is a basic standard? A basic standard is a long-term standard that remains unchanged over a period of time. Long-term standard that remains unchanged over a period of time. Long-term standard that remains unchanged over a period of time. Next, we have current standard. Current standard. Current standard. current standard. So it is the opposite of basic. So these are standard that represents the current operating conditions. That represents current operating conditions. It's based on current efficiency levels. A standard that represents current operating conditions. A standard that represents current operating conditions. So those are the types of standards that we have. So if you've been asked types of standards, you know ideal standard, attainable standard, basic standard, and current standard. Okay, I'm giving you 30 seconds for you to absorb that. This topic is quite wide. It's very wide. So just be patient with me with very many formulas. So just be patient with me as we continue. Okay. So that is types of standards. We have looked at them. So why don't we go to what we call a standard cost card? A standard cost card. So a standard cost card is what helps to calculate, the planned unit cost of a product or service. It helps to calculate the planned unit cost of a product or a service. Okay, let me just talk of a product. It helps to calculate the planned unit cost of a product. It helps to calculate the planned unit cost of a product. Helps to calculate the planned unit cost of a product. How does a standard cost card look like? Let's take note of this. Okay. Just a second, please. So we'll have something like that so that we can see the format. How does this card look like? How does the standard cost card look like? So this is a format of a standard cost card. So in a standard cost card, here, suppose we are working in France. So suppose we are working in France. Here we are looking at planned what? Planned is the same as budgeted cost per unit. That is what we are trying to look at. Budgeted cost per unit. So in order to get the budgeted cost per unit, you will start by getting your direct materials per unit. Direct materials per unit. To it, you add direct labor per unit. So we have something like that. Now, when you add those two, it gives you what is called prime costs. Prime cost is what we call direct costs. Prime cost per what? Per unit. Prime cost per unit. Prime cost per unit. When you add those two. So when you add these two, it gives you prime cost. Now to the prime cost, you add variable production. So let me just call variable overheads. Variable overheads, of course, per unit. Don't forget that. Per unit. You add variable overheads per unit. When you add variable overheads per unit, what you get is called marginal cost. Marginal cost. Marginal cost. What you get is called marginal cost. To the marginal cost, you add fixed production overheads or costs. Overheads. You add fixed production overheads. What you get is called absorption cost. Absorption cost. You get is absorption cost. To the absorption cost, just a second. Okay, to the absorption cost, we add fixed non-production costs. Of course, these are always selling, distribution, admin costs. Selling, distribution, admin, and even sometimes finance costs. Admin costs. Selling, distribution, admin. So you add them there. What you get, when you add that, what you get is called standard cost. Standard cost. So what you get there is called standard cost. To the standard cost, you add profit. You add profit per unit. When you add profit per unit, what you get is selling price. Let me call it standard selling price or standard price. Standard selling price. So the answer you get is standard selling price. So please master this format. It is extremely important. I'm giving you time to note it down. I'm giving you time so that you can note it down. So when you want to calculate the cost per unit of a product, the standard cost per unit of a product, that is the format that you use. Remember, I've said there is a lot we want to cover today. A lot. So master that format. So when you want to calculate the budgeted cost per unit, okay, I don't even need to say that, you already know it. So you already know that. So prime cost. So how do you get prime cost? You add direct labor, direct materials to give you prime, add variable. So to that, when you add variable, so here you add fixed production, here you add fixed non-production, and finally there you add that. Okay, so that is what we have. So the examiner can ask you calculate the prime cost. You can be asked calculate the marginal cost. You can be asked calculate the absorption cost, or you can be asked standard cost, or even price, or standard price, or standard selling price. It means the same thing. So I hope those who are writing have finished. So that is called a standard cost card. So remember the key point, it helps calculate the cost per unit of a product or a service. It helps calculate the cost per unit of a product or a service. It helps calculate the cost per unit of a product or a service. So maybe we can look at example in Excel. In what? In Excel. In Excel, or even your notes. An example is in Excel or even in your notes. So example, let's look at an example in Excel. So read that question and read it carefully. Read it and read it carefully. Sorry for that. Sorry, I'm just making some adjustment. So read that and read it carefully so that we can start. Okay, the question reads, I always start with the required. Prepare the standard cost card in order to establish the standard cost of 1 unit of product. Okay, prepare the standard cost card. That is the question. So solution, we are preparing so KK Limited standard cost card. Standard cost card. So that is what we are preparing. Now, in order to prepare a standard cost card, remember the format that we have said. What do you start with? KK manufactures product 20K. Information relating to this product is given below. Budgeted output for the year. Budgeted output for the year is 900 units. Standard details for 1 unit. Standard details for 1 unit. You have been given direct materials, direct labor, that is wages, for 2 departments, bonding and finishing. Next, you have been given budgeted cost and hours per annum per year are as follows. Variable overheads, bonding and finishing has been given. Fixed overheads apportioned to this product. Production, selling, distribution, and administration has also been given. So note, the variable overheads are recovered using hours. The variable overheads, these ones, are recovered using hours. Fixed overheads are recovered using units. Fixed overheads are recovered using units. Fixed overheads are recovered using units. So that is what we have in our question. Now, in order to get the cost per unit, so I'm working in dollars, take note of that. Now, what did we say? What do you start with? You start with direct materials. Direct materials. Now, in our direct materials, it is equals to standard details of 1 unit. It is 40 This is for 1 unit. So I can just copy this and bring it there. So I can just take 40 times 40 times, of course, you know that is 5 per meter. So 40 times that. So what does it give you? 40 times 5.3. What do we have? 212. That is direct materials. So direct materials is 212. Next, we go to direct labor. Direct labor. Here, our labor is also called wages. Direct labor, also called wages. We have 2 types of wages. We have one for the bonding department, and we also have one for the finishing department. For the finishing department. We have for the bonding department, and we also have for the finishing department. So for the bonding department, it is 24 hours times 5. Of course, $5. $5. For the finishing, it is 15 hours, of course, times 4.8. You get that. So the answer we get is 24 times 5. 24 times 5 is 120. Here the answer we get is 15 times 4.8. It gives you 72. So that is remember, this is for the bonding department. That is for the bonding department. So if we add that, what do we get? We said we get prime cost. So what is our prime cost? You add that. Our prime cost is an addition of that. So our prime cost is 404. 404. Now to the prime cost, we have said you add, what did we say? Variable overheads. Variable overheads. And in variable overheads, again, we have for 2 departments, bonding department, and we also have for finishing department. So we have 2 departments, bonding departments and for the finishing department. Bonding department and for the finishing department. We have 2 departments there, bonding and finishing. Now, in the bonding department, you are being told, take note of this, budgeted cost and hours per annum. This is not per unit. This one is per annum. So what is the bonding cost per annum? It is 45,000 in a year, and in the total year, we have 30,000. So what you do in this case, you take 45. I hope everyone is taking note of this. What you do there, you take 45,000. You divide it. Okay, you divide it by 30,000. Sorry, that was 450 instead of 45. 30. What you get here, is per this is per hour. The answer you get is per. Okay, that is difficult to handle. So what you do is this: 45,000 divided by 30,000. What does that give you? That gives you, it gives you the variable overheads per hour. I'm repeating. $45,000 divide by 30,000 hours. What does it give you? It gives you the variable cost per hour. And then you ask yourself, how many hours were used for 1 unit? This one here. How many hours were used for 1 unit? The hours that were used per unit is 24 hours per what? Unit. Times 24 hours per unit. Times 24 hours per unit. Times 24 hours per unit. So the answer that you get here is 45,000 divided by 30,000 times 24. So bonding, that is the answer you get. 45,000 divided by 30,000 times 24. So for the bonding department, that is what you have. For the bonding department, that is what you have. Next, you go to the finishing department. For the finishing department, you also repeat the same procedure because you are being told your variable overheads are recovered using hours. So you take these, you divide by the total number of hours in a year, and then you find out how many hours are used to make 1 unit. How many hours are used to make 1 unit? We repeat the same for finishing. So for finishing, it will be $25,000 divide by 25,000 hours times 15 hours per unit. Times 15 hours per unit, you get the answer. So times 15, so that will be 25,000 divided by 25,000 times 15. So we have that, add variable overheads. So variable overheads, there is for the bonding and there is for the finishing. So what you get in this case, it gives you what we call, what did we call it previously? Marginal I'm wondering why this did not change. So what you get is called marginal cost. Marginal cost. So what is our marginal cost? Marginal cost is 404 plus 36 plus 15. What you get is 455. What you get is 455. To the 455, we add, what did we say? To the 455, we add fixed production. Fixed production. You add fixed production costs or overheads. Fixed production overheads. Now take note of this. What were we told about fixed production overheads? Fixed production are apportioned to this product. Per year, it is 36,000. But you are being told fixed overheads are recovered using on a unit basis. Unit basis. So what you take here it will be 36,000, which I believe everyone is seeing. You divide by the number of units because that was per year. 36,000 is per year. You divide it by the number of units. So that will give you 36,000 divided by number of units is 900. It gives you 40. So what the total that we get here is absorption costs. Absorption costs. Absorption costs. So this is 455 plus 40 gives you that. It gives you absorption costs. So marginal add fixed production overheads, it gives you absorption costs. So that is what we have. Next, we say to the absorption cost, we said you add fixed non-production. You add fixed non-production. Fixed non-production, you know, overheads, of course, I'm writing in abbreviations. Overheads, I'm using abbreviations. You know, these are the selling, distribution, administration, and finance cost. Selling, distribution, administration, and finance cost. So this is 27,000 divided by 900 units. Divided by 900 units. So that gives you 27,000 divided by 900. So what gives the answer you get there is standard cost. Standard cost. Standard cost. Standard cost. So the answer you get there is standard cost. Now to the standard costs, what did we say? You now next look for profit per unit. Profit per unit. You are being told the profit markup is estimated to be 25% of standard cost. So profit markup is 25% times standard cost, 525 times 525. Whatever you get there is equals to 25% times 525. So what do you get? 131. So the answer you get will be called standard price or standard selling price. Standard selling price. Standard selling price. 525 plus 131. So the standard selling price is that. That is your standard selling price. And that is what we call a standard cost card. A standard cost card. So it is something that is fairly straightforward if you understand the flow. Fairly straightforward. So remember, that is prime cost. That is marginal cost. That is absorption cost. That is standard cost, and this is standard selling price. Standard selling price. So that is what we have there. I hope we are together. I'm giving you time to absorb it. I'm giving you time so that you can look at the question and you look at the answer. So 2 minutes to look at the question again, because look at what the question was asking you. You indicate prime cost, marginal, absorption, standard cost, and standard price. That is what we have indicated there. So you can take your time to look at it before we move a step further. Okay, 2 minutes, 2 minutes. Profit per unit is a percentage of the cost. Profit per unit is a percentage of the cost. 25% of the cost. What is the use of standard costing? Early, normally at the beginning of the year, you prepare budgets. This is a budget. This is the budgeted price. 620.56 is the budgeted price of this product. So at the beginning of the year, you prepare a budgeted price. A budgeted price per unit of a product is called a standard cost card. So it helps you to budget for the price of a product before you start selling it. So that is a budgeted. It helps you in planning. It helps you in planning for activities during the year. You are planning that you will be selling the product at 656. The total cost of the product per unit will be 525. Absorption cost of the product per unit will be 495. Marginal cost of the product per unit will be 455, and the prime cost of the product. So in short, standard cost card helps you to plan for all costs involved in the making of a product. It helps you to plan for all costs involved in the making of a product. Are we together, Ellie? You can type yes if you've understood. Any other question before we move on? You know, a standard is a target. A standard is a target. So when you plan for one product, remember the chapter that we have just covered, budgeting, helps to prepare the budget for the whole organization. So when you are budgeting, you will set a price of 655. So this standard cost card helps you identify components that you will use in order to make a budget. It helps you to know that the budgeted price is 656. So after this, you'll be in a position to prepare what? You'll be in a position to prepare which type of a budget? Sales budget through this. Because in a sales budget, you need this selling price per unit times the number of units. You'll also be in a position to prepare a materials budget. You'll also be in a position to prepare a labor budget, variable overheads budget, and even fixed. So these components are the components that are used to help you to prepare a budget. To help you to prepare a budget. I don't understand what Caleb you are asking. Now, you know, this is a whole topic altogether, Caleb. What is a markup? Markup, but this is financial accounting. I don't want to go to financial accounting. Markup is profit on costs. Markup is profit on cost. There is also what is called margin. Margin is profit on price. Markup is profit on cost. Margin is profit on price. So here you are being told the markup is 25%. Even if you are not told of standard cost, you need to know it is 25% of the cost. What is the cost? 525. That is the markup. Margin is profit on price. So if we were told margin is maybe 20%, it is 20% of the price. So e.g. 20% of what? 656. However, Caleb, that is financial accounting. You should know that. Okay. So we were not given margin. You are not given the margin. So we were given the markup. Okay. Why don't we continue? I hope we've understood that. So let's continue. So we have looked at a standard cost card. Now the topic, standard cost. Why do we calculate standards? Why do we prepare standards? Why do we prepare budgets? So that at the end of the day, actual performance can be compared with the standard set. The objective of setting a standard is to enable you to compare actual performance to the standard that was set. The difference between actual performance, and the standard that is set is what is called a variance. So for the next 1 hour, let us look at variance, and then we will continue with it on Saturday. So variance, let me call it variance analysis. It is part of this topic. So I'll start by saying a variance is the difference between budgeted. The other word for budgeted is standard. The other word for standard is planned. Planned. The difference between budgeted figures and actual results. It's the difference between budgeted figures and actual what? Results. Is the difference between budgeted figures and actual results. So if somebody asks you what is a variance, you'll tell him variance is the difference between your budgeted figures and actual results. So for example, in the beginning of the year, you budget that you will be making sales of 10 million during the year 2021. You find at the end of the year, you have made sales of maybe 8 million. So that is the difference. The difference is called a variance. Next, variance can either be favorable, normally abbreviated with the letter F, or some books abbreviate it as FAV, or adverse. Variances can either be favorable or adverse. Some books call it A or ADV. So variance can either be favorable or adverse. Variances 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 can either be favorable or adverse. Now, when do we have favorable? I had also touched on this in the topic budgeting. When do we have favorable? Favorable when the actual performance is better than budgeted target. Favorable is when the actual performance is better than what? Is better than the target. Next, adverse is when actual performance, or when budgeted, how do you write? Budgeted target is better than actual performance. 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 So that is what we have. Now, for costs, into bracket expenses, favorable arises when for costs, that is expenses, favorable arises when actual costs are less than budgeted costs. Budgeted what? Costs. For costs, favorable arises when actual costs are less than budgeted costs, while adverse arises when actual costs are more than budgeted. Are more than budgeted. Are more than budgeted. Are more than budgeted. For costs, that is expenses, favorable arises. Favorable arises when actual costs are less than budgeted costs. Adverse arises when actual costs are more than what? Budgeted. When actual costs are more than budgeted. That is adverse. For incomes, e.g. sales, e.g. sales. F when, we said F when actual sales are more than budgeted, and A when actual sales less than budgeted. Actual sales is less than budgeted. Is less than budgeted. So that is what we have there. So in that case, that is what we have in introduction to variances. Any question, we are saying variances can either be favorable or adverse. Variances can either be favorable. Variances can either be favorable or it can be adverse. You should know when is it favorable and when is it adverse in that introduction to that. Now, let us move a step further. So in this, let's look at causes of variances. Causes of variances. What causes are variance? Variances are caused by either change in prices per unit or change in quantity, or both. I'm repeating. Causes of variances can either be change in prices, that is number one, change in prices. So change in prices, or number two, change in quantity. Quantity is the number of units, or both. Change in price per unit and quantity. What do you mean by that? If you are doing some investigation and you found out that there was a change, maybe we budgeted to make sales of 10 million. We actually made sales of 8 million. And then you want to investigate what caused the changes in variances. What caused the changes in variances? Now, here, when you want to investigate, remember the change in variances, either prices changed, selling price per unit changed, or the number of units being sold changed. Maybe we had planned to sell 10,000 chairs, but we only sold 8,000. Maybe we had planned to sell chairs at 10,000 per chair or 100,000 per chair, but we only sold at 80,000 per chair. So causes of variances can either be change in price, change in quantity, or both change in price and change in quantity. So that is the main thing. So all variances we are going to cover, they revolve around that. But before I continue more on that, let's maybe look at factors to consider before investigating variances. Now, remember, when there is a variance, you must investigate what caused the variance. When you find there is a variance, maybe we had budgeted to make sales of 10 million, and you actually made sales of 8 million, you must carry out investigation to find out what caused the variance so that next time you can improve on your performance. So what are the factors to consider before investigating a variance? The first factor is materiality. Materiality. So in this case, what do we mean by materiality? It is how much is the variance. We look at consider significance of the variance in comparison to the budget, Now, if you find that the variance was 2 million out of 10 million, that is 20%. That is a very big variance. So you consider materiality. Materiality is the significance. You consider the significance of the variance in comparison to the budget. If you find the variance is too small, very small, you don't need to investigate. Okay, somebody has referred me to the previous slide. Okay, I've put for you there previous slide. These points are very important in the topic standard costing. Don't worry about formulas. Formulas we will learn. Formulas we are about to learn. We'll actually get tired even of them. So variances, those are the causes. I think 5 seconds have gone. So we are saying that the first factor to consider is materiality. The second factor to consider is controllability. Is controllability. In other words, is the cost of the variance within the control of management. Is the cause of the variance within the control of the management? Is the cause of the variance within the control of management? For example, e.g., inflation is not within the control. Control what? Of management. So inflation is not within the control of management. Inflation is not within the control of management. So if there was a change as a result of inflation, you don't need to investigate, because even if you investigate, so what? You'll not be in a position to control inflation. Inflation is a macro factor. Economists tell us that. You know, we are accountants. So economists tells us inflation is a macro factor which affects the whole industry or the entire country. It does not only affect your business. So it is not within the control of a manager. Next, interdependence. How do you write interdependence? The interdependence between the variances. Interdependence between the variances. Interdependence between the variances. Now, sometimes you find that reduction of price, e.g., reduction of price may lead to increase in what? Demand, and therefore quantity. And therefore what? Quantity. So decrease in price will lead to increase in demand. That is, economists again tell us that. Law of demand and supply. The principles of demand and supply. Interdependence between the variances. Remember, we have said causes of variances, either price change or quantity change. So you may reduce the price, which causes adverse price. But if you reduce the price, you expect the sales units to increase, and therefore the quantity variance will increase. So interdependence between the variances may also may be a factor to consider before investigating the variance. Next, cost of investigation. 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 Now, remember, you should only investigate if the cost is less than the variance. Only investigate if the cost of investigation is less than the variance. Now, for example, if you find that the variance is 1 million, and in order to investigate the variance, you will pay maybe some auditor 2 million. You don't need to investigate, because you'll be spending more on investigation more than the variance in itself, more than the variance. Next, maybe the type of standard set. So another factor is the type of standard that has been set, is a factor to be considered. E.g., if ideal standards are set, we expect to have adverse results. If ideal standards are set, we expect to have adverse results because ideal standards are based on what? Are based on perfect operating conditions. Because ideal standards are based on perfect operating conditions and are therefore not achievable. Are therefore not achievable. They are based on perfect operating conditions, and therefore they are not achievable. And therefore they are not achievable. Those are some of the factors you need to consider before you investigate a variance. Factors to consider before you investigate a variance. Factors to consider before you investigate a variance. So you look at materiality, you look at controllability, you look at interdependence between the variances, you look at cost of investigation, and the type of standard that has been set. The type of standard that has been set. Okay, let us continue. Okay, 1 minute for that to sink in. materiality, controllability, interdependence between variances, cost of investigation, and the type of standard that has been set. The type of standard that has been set. Type of standard that has been set. I hope we are together. I'm trying to be a bit slow. I'm trying to be slow. Okay. Now, types of variances. Types of variances. Types of variances. Types of variances. I want us to follow these very keenly. Types of variances. We have the following types of variances. Number one, there is what we call sales variance. Or let me call it sales price variance. Sales price variance. The second variance is called sales volume variance. So remember, this is caused by changes in prices, changes in sales price. This is caused by changes in quantity. So the second one is called sales volume. I'm first of all listing them. Or let me change a way of listing them. Sorry for that. Let me just change the way of listing them so that let me use a table. I think a table will be better. Okay. A table can present it nicely. So a table can bring it more nicely compared to okay. So number one, we have what we call sales variance. Sales variance. I'll just add sizes if it doesn't fit. Sales variance. There are two types of sales variance. 1.1, there is what we call sales price variance. And 1.2, we have what is called sales volume variance. So under sales variance, they can be either be sales price variance or sales volume variance. Number two, the second type of variance is material variance. Material variance. Material variance, it can either be material price variance or 2.2, it can be materials usage variance. Material usage variance. That is the under material variances. So it can either be material price or usage. You remember budgeting, utilization or usage. Number three, we have labor variance. Labor variance can either be 3.1. It can either be labor rate variance or 3.2. It can be labor efficiency variance. It can either be labor rate variance or labor efficiency variance. Number four, we have what is called variable overheads variance. Variable overheads variance. Variable overheads variance. So variable overheads variance, it can be, in this case, variable overhead expenditure variance, or expenditure variance, or variable overhead efficiency variance. So that is number 4. So I'll duplicate that so that I go. So number 4, that is number 4. So number 4 is 4.1. And here we have 4.2. 4.2. So we have our 4.1 and 4.2. So let me delete this. So that it fits. So I'll duplicate that. So we've reached number 4. Duplicate. Number 5. Number 5, we have, so number 4 was variable. Number 5, okay? Number 5, we have fixed overhead variance. Fixed overhead variance. Fixed overhead variance, we have 5.1 fixed overhead expenditure variance. And number 2, we have 5.2 fixed overhead volume variance. Fixed overhead volume variance. So we have fixed overhead expenditure variance, and we have also fixed overhead volume variance. So this volume is only under absorption costing. Absorption costing. Only under absorption costing. Only under absorption costing. So next, 5.2. Look at these. These are subdivision of that. 5.2. What is 5.2? Fixed overhead volume variance is subdivided into 2. There is 5.2.1. So it will be fixed overhead volume efficiency variance, and 5.2.2 fixed overhead volume capacity variance. Capacity variance. So those are the variances that you need to know. Remember, fixed overhead volume is this one. So fixed overhead volume variance only under, we have said, only under what? AC. So maybe I can have a note here. Note NB under marginal costing, there is no fixed overhead volume variance. Under marginal costing, there is no fixed overhead volume variance. Under marginal costing, there is no fixed overhead volume variance. So under marginal costing, there is no fixed overhead volume variance. So remember, this is 5 point. Let me just put it this side. 5.2. 5.2. This is 5.2 there. This is 5.2 there. So I'm putting it in red so that you know it is that variance there, that 5.2. So we have, those are the variances. Maybe for the next 20 minutes, let us look at the formulas, and then that will be it. We will come another day and now cover them one by one. So I'll duplicate that. So let us look at formulas of variances. Please take notes of these formulas. Formulas of variances. Formulas of variances. I'll take a lot of time here. So 1.1 was what? Sales price variance. Sales price variance. Sales price variance was 1.1. Let me reduce the size so that is too small. Maybe 28. Sales price variance. So what is the formula for sales price variance? Sales price variance is equals to, look at this, budgeted. Please, if you don't understand the abbreviation, write it in full. Budgeted price per unit minus actual price per unit. If you don't understand abbreviation, write it in full, times actual quantity. If you don't understand, write it in full. Just write it somewhere. Budgeted price per unit minus actual price per unit times actual quantity, of course, in units. Actual quantity in units. That is which variance? That is sales price variance. 1.2. Sales volume variance. Sales volume variance. This one depends. There are two formulas. There are two formulas here. So the first formula is budgeted quantity minus actual quantity. Variance is the difference between budget and actual. Anyway, that one everyone knows. Quantity. Outside the bracket, you multiply by budgeted profit per unit. Per unit. This one is used under absorption costing. Under absorption costing. I will explain that. Under absorption costing, that is AC. So used under absorption costing. So budgeted quantity. So the keyword there is that. Used under absorption costing. It can also be budgeted quantity. I'm again repeating. If you don't understand the abbreviation, you can write it in full. Minus actual quantity, close the bracket, times budgeted contribution per unit. Per unit. This one is used under marginal costing. Marginal costing. Under marginal costing MC. Under marginal costing MC. So either this or that. So take note of that. So that is used So in sales volume, there are two formulas. You know, if you have been asked under absorption costing, that is the formula you use. Number 3, maybe let me have 1.3. 1.3, total sales variance. Total sales what? Variance. Total sales variance is equals to sales price variance plus sales volume variance. So it will be equals to sales price variance, which is 1.1 plus what? Sales volume variance, which is 1.2. 1.1, I hope you've understood the meaning of that. Okay, so next 2.1. 2.1 is materials price variance. Material price variance. Today we are just listing formulas. Materials price variance. How do we calculate materials price variance? Materials price variance is equals to budgeted price per kg, or the unit of measurement of materials, minus actual price per kg times actual quantity in kgs. This quantity was in units. That quantity was in units. This one is now in kgs. That is material price variance. Material price variance. Next, 2.2, material usage variance. Materials usage variance. Materials usage variance. Material usage variance, again here, the formula is, this one is a bit different, budgeted quantity for actual production minus actual quantity times budgeted price per kg. Please take note of that. Budgeted quantity for actual production minus actual quantity into bracket multiply by budgeted price per kg. Multiply by budgeted price per kg. Multiply by budgeted price per kg. Okay, that is material. So here 2.3. So 2.3 will be total material variance. Total material variance, which is equals to, total material variance is equals to, you all now know, material price variance plus material usage variance. 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 Okay, so those are next. So we have reached number 2. I'll again duplicate that. So I'll go to number 3. Let me remove those ones. Number 3.1 is what? Labor rate variance. And always use the names that we have used. Don't use your own names. Labor rate variance. Labor rate variance is equals to budgeted rate per hour minus actual rate. This is the reason why I wanted to cover this chapter earlier. This is normally the last chapter, but if I cover it as the last chapter, you have a very short time to remember the formulas. That is why I decided to cover. Now you understand why I skipped to chapter 13 and chapter 14, so that I give you good time to remember the formulas. That is why I covered them before chapter 10, 11, and 12, so that you remember the formulas. So budgeted rate per hour minus actual rate per hour times actual hours times actual hours. That is 3.1. I'm repeating 3.1. Budgeted rate per hour minus actual rate per hour times actual hours. 3.2. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. How do we get labor efficiency variance? Labor efficiency variance is equals to budgeted hours for actual production minus actual hours into bracket times budgeted rate per hour times budgeted rate per hour times budgeted rate per hour. So labor efficiency variance is equals to budgeted hours for actual production minus actual hours times budgeted rate per hour. We have 3.3. 3.3. Total labor variance. Total labor variance. Total labor variance. Total labor variance is equals to, of course, is equals to labor rate variance plus labor efficiency variance. Labor rate variance plus labor efficiency variance. Number 4.1, variable overheads. Variable overheads expenditure variance. Variable overheads expenditure variance. It is the same as this, but you use, it is the same as that. It is the same as, but you use the variable figures. So variable overheads is the same as labor rate. The formula is the same, but you use the variable figures. You use the variable figures. So next, 4.2. 4.2 is variable overheads. Which variance? Efficiency. Efficiency variance. Variable overhead efficiency variance. Now, can I remember this variable? Yeah, it is the same as variable overhead efficiency is the same as labor efficiency. You can see it here. The formula is the same. It is just that you will be using variable figures. That is the same formula. 4.3, total variable overheads variance. So in this case is equals to variable overhead expenditure variance plus variable overheads efficiency variance. we have that. So that is category 4 of variances. We are almost there, don't worry. We are almost there. So the last category is category 5. Category 5 of variances. Category 5. Category 5. Category 5. 5.1. So 5.1 was fixed overhead expenditure variance. This is normally the easiest. Fixed overhead expenditure is budgeted, fixed overhead costs minus actual fixed overhead costs. Yeah, that is what we have. Now, into bracket, it can be budgeted fixed cost per unit times budgeted units, budgeted production units, minus, again into bracket, actual fixed cost per unit times actual production units. Actual production units. So that is what you have. So it is that. Next, 5.2. 5.2, what did we call 5.2? Fixed overhead volume variance. Fixed overhead volume variance. It is budgeted production units minus actual production units times budgeted fixed cost per unit. Some people call it FOAR, which is still the same. FOAR, fixed cost per unit. Only under AC. Only under AC. Under MC, there, the variance is not there. The variance is not there. Take note of that. That is only under what? AC. Take note of that. That is only under AC. Under MC, the variance is not there. Next, 5.2.1. 5.2.1. Fixed overhead volume efficiency variance. Fixed overhead volume efficiency variance. The formula is budgeted hours minus actual hours times, outside the bracket, budgeted, of course, fixed cost per hour, not per unit, per hour. Per hour. Okay, remember, this is total budgeted hours. Here also, total actual hours. Next, 5.2.2. Fixed overhead volume capacity variance. Fixed overhead volume capacity variance. So the formula is budgeted hours for actual production. For actual production minus total actual hours. Of course, you multiply by budgeted fixed cost per hour. Budgeted fixed cost per hour. You multiply by budgeted fixed cost per hour. Note, take note, merge cells, note NB, note fixed overhead volume efficiency variance plus fixed overhead volume capacity variance is equals to fixed overhead volume variance. Take note of that. Is equals to fixed overhead volume variance is equals to fixed overhead volume variance. Those are the only few formulas I wanted us to learn. So when we meet next time, what do you mean by is over or times? Times. Outside the bracket is always times. Outside the bracket is times. Outside the bracket is times. So, okay, here, are you seeing these values, these ones? These values just help you. These values, this one here, these ones here just help you to calculate this. It is not over. These ones are just how you calculate. These ones just help you. They just help you to calculate budgeted fixed overhead only, period. Nothing more, nothing less. Now, what I want us to do when we come next time is to look at examples. Examples, that is what we'll do in the next class. So next class is what time? Saturday at 1. It is a make-up class. Keep time. Saturday at 1. Saturday at 1. We will be covering examples of all those variances. Saturdays at 1. Fixed overhead expenditure. Somebody's asking fixed overhead expenditure. This fixed overhead expenditure, if this is confusing, I can just remove it. Whatever I had written there was just to explain how you get this. How do you get that? It is budgeted fixed cost per unit times the number of units. How do you get this? It is actual fixed cost per unit times the number of units. You can just remove it if it will confuse you. So that brings us to the end of the class. So next time we will look at, can someone master all these? Ange, I've mastered them. I'm not teaching. I don't teach by referring anywhere. I've mastered them. So you can also master. That is why I always don't read when teaching. So that you are in a position also to gain confidence to master. Okay, somebody's returning me back to slide 132. Okay, we have finished the class, so you can just return me to any slide you want. We have finished the slide. So Ange, please, that is why this is the last chapter, but why have I not taught it as the last chapter? So that you have time to master. That is why I've taught it 1 month to exams. Remember, you are still remaining with 1 month to exams, so that you try to remember. Ali, don't, we will tackle that when we reach there. Idle time variance. Okay, Ali, I'll explain that later on, not now. Idle time variance is the expected minus actual times the rate per hour. Expected idle time minus actual idle time times the rate per hour. But I'll explain that later on. Expected idle time, Ali, I'm answering you. Expected idle time minus actual idle time times rate per hour. And idle time will always be adverse. Idle time will always be adverse. Expected idle time minus actual idle time times the rate per hour. Ali, are we together? Okay. I know many variances. I'm just teaching you. Or if I went even back to this, in your syllabus, I'm just remaining. In your syllabus, these are the variances. But we also have what we call advanced variances. You can see this usage. This usage is again divided into two. There is material mix variance and material yield variance. There is also what we call planning and operational variances. There are very many variances. I'm only remaining within your syllabus. There are many variances I've not taught you. I'm only trying to teach what is in your syllabus. So slide 133. So anyway, have a good night. You are free to leave the class.